All right, what's going on, everybody? Hopefully, y'all having a pretty good day. You should be able to see my screen. The preview isn't showing on my end for some reason. It's a little weird. Oh, what's up? Let me make some adjustments because things aren't going where they're supposed to be going. Are you ready for NVIDIA? Right? I'm down for that. Like, just do the thing already. I have an earnings chart that I use that helps review previous earnings and kind of get a feel for upcoming earnings. And we might take a look if we have time at that too. Okay, so I think I got things adjusted now. I was hearing you through my sound system, not through the earbuds I'm wearing. And if you're talking now, I don't hear you at all. So maybe I broke something. I hate push to talk. I turn that off. I just talk. The only downside with that, I have to remember to keep it muted. But with the headphones that I'm wearing now, when I flip the mic up, it mutes automatically. And the rack that I set them on, they sit with the mic up. That's the only way they'll sit on there. So I know if I take my headset off, I'm muted at the bare minimum. All right, so we got a pretty good topic to go over today. This one's near and dear to my heart for sure. It was something that I really got excited about when I first got into options, and it's the topic of high probability trades. This is a really fantastic topic, but it can get a little bit in the weeds, right? Because there is some science behind the math. And if you lack the math capacity to really grasp the statistics behind it, then you don't really get the joy or you don't get the confidence of the trade because you don't really understand how likely it is that the outcome is going to come true, right? So we first do need to distinguish one, what the hell am I even talking about? But two, the qualifications or the definition of a high probability trade in the trading world versus the options trading world. These are two entirely different concepts. In the trading realm, if I'm trading stocks, futures, just anything with price that's moving, a high probability trade would be a trade that has an outcome that's been, peer reviewed, that we've back tested it, we've researched it, we've had multiple uh, people go back and examine it, and everybody agrees that it's a trade that works frequently, high probability trade. And then usually that comes with statistics and numbers of its own. In the options world, when we talk about high probability, it's usually just based on the years and years of research in the options world and the outcome of the standard deviation concept. We're not going to go into math class today, but there is a little bit of logic when it comes to the bell curve of the one standard deviation option. And if you haven't seen it before, maybe you have and you didn't even realize it. So if we go into the Analyze tab, this gray area That's your one standard deviation bell curve, right? It's not showing, but it would be this kind of a half moon. Let me turn the fade on, off, however you want to say that, so that my line just stays there, or at least maybe stays there a little longer. It's supposed to have that curve, right? So in that kind of trading environment, anything that fits inside of that is the 70 percentile, anything in this gray area. So when we build high probability trades in options, one of the things that's really unique is we can actually pick the probability that we want. That's different than the way we would trade stocks and futures, right? Usually we pick a strategy and then we look to see what its typical outcome is. And we decide if we like the strategy or not based on whatever the answer was. In options, you choose what kind of probability do you want? You want a 60%, 70%, 90%? And if you think about it, you could intuitively believe, why not just, give me that 99 percentile trade, the one that wins dang near any time you ever trade it whatsoever, right? Why not? If you can pick your win rate or your probability of winning, why wouldn't you want a 99% chance of trade winning? I mean, who wants to invite the losers to dinner? But I'm going to show throughout today that you really don't want that high probability trade. So, in the options world, I got really excited when I found out that you get to choose what kind of probability you want. I mean, what's not to like? It sounds fantastic. We choose that by determining, uh, by understanding where the number is for that determination. So, on different platforms, you can find this different ways. I'm going to show you the old school way, and then I'll show you the more modern version. Old school is delta. So if I look at an option out here, say the 580, it's got a delta of 43. That has a 43% chance of closing in the money at expiration. That's my probability right there. Being in the money would be considered profitable, but we can define profit a lot of different ways, right? And that's where we kind of fall down the rabbit hole and it gets a little weird. We want to just talk about today, when it comes to probabilities, that the trade was held all the way to expiration, which I'm not encouraging anybody to do. You take assignment risks and you take, um, high gamma risks, and it's just not. It's not what we want to do. But we're just talking about the probabilities of a trade being successful or profitable. All the math is done with an eye towards expiration, which is why there's cheats or hacks to get high probability trades without the high probability statistics. And that's good for all of us, right? That's the key to the whole thing, which we're going to get to today as well. So we could we could spend time me trying to get you to the point where you understand the math so that you'll trust that it's a high probability trade, or we can just talk about the fact that they're high probability trades. And I'm going to pick the latter here because the math, even at the end of it, there's no guarantee that I'd actually ever convince you to trust these as high probability trades. You just have to accept it as fact, right? The sun rises and falls every day, and what goes up must come down. It's just facts. So the math is clear. It has a historical precedent to it, and billions of dollars are traded around the world based on this logic. There's nothing more I could give you to get you to trust the math. If the delta says 49, then at expiration, that option has a 49% chance of closing in the money. If you wanted a higher probability of closing in the money, then pick a higher delta. If we're selling options, it's the other way around. So if I sell a 585, this has a 34% chance of losing because if I sold it, I don't want it in the money, right? Which, if you take the other side of that, it has a 66% chance of winning. So if I wanted a 70, 80, 90% chance of winning, I could just keep my eye on that delta and go out until I have a delta of 15 or a delta of 10. And then I would have a higher probability trade. The reason we don't want these, or at least the reason I don't want them, and why I argue that you probably don't want them, is everything in the options world is fair and balanced. Not everybody agrees with me on that, but the options world it really is fair. If I ask you if you want to take a trade with me, or at least go against me, and I want to bet you that the sun comes up tomorrow, I got a high probability that I'm going to win, right? Do you really want to take the other side of this trade? I mean, why not, right? Now, to be fair, since I'm damn near guaranteed to win and you're not, what should I get if I win? And what should you get if you win? Well, I'm going to win every day. And you're going to win the one day that the world isn't here ever again. So, that 1 in a million crapshoot. Since I'm winning every day, my win should be really low. It shouldn't break the bank because one, I need you to come back and bet again tomorrow. But two, I'm the one with all the probability in my pocket. You're the one that's going out on a limb and taking the other side of the trade. And what if you actually did win? Well, you should get the biggest prize out of the whole package. So, if you think about these high probability trades, and the reason that you don't want them is they have a very low payout. And of course, the argument for that is, well, I'll just put more on, right? If a one lot has a really low payout of $2, then I'll put 100 of them on. And then, I have $200. And that's usually what people do right up until the day they blow up their account and then they're gone. And it's not just people. Institutions do it. You read about them in during COVID and other high volatility events. These mom and pop assets under management blow right the hell up. Why? Because they sized up when things were calm, and when they weren't calm anymore, they got ran the hell over and they're gone. They lost all their money, all their clients' money, and they just don't exist anymore. Nearly every one of those companies that went out of business was taking the high probability trade and then they sized up because they wasn't really getting the profit that they wanted, and it worked for a while until the one day that it didn't, and then they're gone. Inevitably, that's the route that it always goes. So, high probability trades, the best analogy that I can give for this that really helps with the math is the gas station lottery ticket. Someone's offering you a chance to make $1 million, and all you got to do is bet $2 or $1, whatever your gas station ticket costs. Well, it sounds fantastic, right? Your chances of winning are really, really, really low. The seller, the house, they're the one selling it to you, and their chance is really, really high. So they're going to sell you that ticket, and you and everybody else who wants to buy it, they're going to sell those lottery tickets like crazy. $2, $2, $2. Hey, they're only making $2, right? Sooner or later, they're going to get hit and they're going to have to do $1 million payout. But until then, they'll just net those $2, $2, $2 forever and ever and get as much of them as they can. So if you're the house and you're out there selling, a $1 wide credit spread and you're selling it for 25 cents, you're risking $75 to make $25. Doesn't sound too bad, right? Since this entire trade is literally a dollar, then we've got a 25% out of that. We're risking 3 to make 1. The delta on that trade is 20. So we have an 80% chance of winning this trade. With that in mind, what we have to be able to distinguish if we are going to take these high probability out of the money trades is, are they paying us enough money? This is why Tasty Trades and Tasty Live, Tom Sosnoff, this is why he says you have to make sure when you are putting on something that you sold to open like a vertical, that you're getting enough money for it. If you're not getting enough money, don't take the trade, because high probability or not, you will lose, right? All trades eventually do lose, no matter what the strategy is. So you have to make sure that you're netting the gains as much as you can when you can, because when the loss does finally come, if you haven't been getting enough money along the way, then that one big loss is going to wipe you out and put you in the hole. There's a lot of different ways that we can define this math to make sure. I've built spreadsheets over the years, and I was thinking about that before, right before the stream, which is why we started a few minutes late. I was looking for it because I wanted to find it. I built a calculator a while back where you put in the width of the spread and how much credit you were getting for that spread, and it would tell you if it was a good trade or not. And the sneaky little trick is, if you did the trade 1,000 times, what would the outcome be? Right? If we took $25 and risked 75 and we won 80% of the time, is that enough to be green at the end of it? We're not adding commissions to that conversation or trading fees or anything else, just those numbers right there. And most of the time the answer is no. I'm not getting enough credit for that delta, or for that probability of profit. I shouldn't take this trade. I'll dig around and see if I can't find that calculator, because I couldn't find it before the stream. And if I can't find it, well, we'll just build another one, because they're not that hard to build. So I mentioned that this is the old school way of doing it. Just use delta. There's a more modern version, and it's called probability of in the money, probability of out of the money. Pretty easy. So PITM, POTM, and POT, probability of touching. Now, touching's kind of interesting. It's a little bit different because it's not talking about I'm going to hold this to expiration, which I recommend you don't want to do, right? Instead, it's saying, hey, what's the likelihood that price actually just hits that strike at some point between the time that I get it and it expires? That price will get around to hitting it at some point. To me, I think that's a more valuable number, because I don't really care about what's going to happen all the way to expiration. Maybe you don't either. So it is a number worth focusing on. Thinkorswim uses probability of touch. That's not bad. It's a little bit proprietary too. They don't exactly tell us how they got that number. Tasty Trades uses P50 instead. And their P50 is using a Monte Carlo simulator that they had built specifically to calculate that P50. They've got videos on it with Mike, their science guy. And you talk about nerding out on some math. That one will send you right down the rabbit hole. So uh, the probability of touch could be used for a lot of different things. It only fits into our conversation today because it's one of the columns on probability, and I wanted to add it to make sure that you knew it was there. Otherwise, when you go to build your trade, you get to choose what your probability is just by looking at the in the money or the out of the money, or like I do, just look at delta. If you want the trade to have an 80% chance of winning and you're short, then just sell the 20. If you're long and you want it to have, you know, an 80% chance of winning, then buy an 80 delta, right? You'd be buying it way up here in the money to have an 80 delta. The math doesn't lie. I've run it every way that I can run it. The only way when you sell to open options that you're getting enough credit to cover the probability is in a high volatility environment. You'll find a little arbitrage now and then, but almost exclusively it'll be because there's a high volatility environment. And therein lies the problem, and why I argue that I don't want to do trades based on that. And in fact, the way that I run my credit spreads nowadays, I don't have to worry about volatility at all, which is just really nice. So, focusing on this high probability, if it has a 80% win rate, that means it loses 20% of the time. Statistically, if you go back in the past and ask, hey, when was that 20%? When it did lose, what kind of trading environment were we in? High volatility. Oh, so options probabilities work really good and they're really accurate. And when we do lose, it's because we were in a high volatility environment that made price go farther than it should have. Yep. And that makes perfect sense. High volatility means price can go farther than we expected it to. So when volatility is low and you're not getting any credit, what do people do? They size up, they stack more on because I'm not getting any money for the trade. I need more money. They make the trade bigger. And then surprise volatility comes along, runs you over, blows up your account. There goes, 100 million in assets under management, and you have to start the whole thing all over again. But if volatility is already high, then you can find those trades relatively easy because, well, there's a lot of juice in the options premium and you don't have to go that far out of the money to find them. The problem is you're still going to lose at a higher rate because volatility is going to run you right the hell over. Any trade can be calculated to define its probability, but it can get a little complicated if you're using multiple strikes. For example, say an iron condor. As long as it's equidistant, it's not too bad, right? I got let's use this. Wow, that's way out. We got a 50 delta way out of the money here. That is crazy. We're skewed wildly today in the cues. Huh. All right, well let's just choose a different expiration then. That one's broken. Maybe we choose a different product. Who broke it? Somebody broke the cues. I'm not sure who they are that you're referring to. The statement is they're not considering max loss when doing cheap vertical spreads. Um, a lot of people, let me add to that. A lot of people on YouTube, those internet gurus that I love to talk trash on so much, they often will say that max loss doesn't count because you'll have time to close the spread. You're right. A lot of them will say that's what stops are for, or they'll say, we got time to get out before it expires and we don't ever have to take max loss. I hear that in those videos quite often. And if that's what you're referring to, you're absolutely right. Yep, people in general. But what I found over the years is if you put on a trade that was really far out of the money, something like a 4 delta or a 10 delta, something like that, and you're wrong, the chances of solving that trade, fixing it, adjusting it, rolling it, modifying it in some way, correcting the issue, your chances are slim to none. Or you'll have to pay up to do it, right? You have to put more risk into the trade to get it done. And sure, for those people who double down or bag hold or buy more when they're losing, those people will do it. They'll add to that risk every time. And a lot of times it works, but it doesn't suit my trading style to add to a losing trade. I don't mind, adding to a trade that isn't working. That's different. Maybe we're just playing with words there, but to me, there's a difference. Hey, my trade ain't working. Let me adjust it. As opposed to, damn, this trade is broken. I'm losing like crazy. I need to get out. Two different things. And they won't calculate that max loss, but they should, because when those trades go bad, they're nearly always max loss. Here's the argument or the problem with the whole system. And we'll just use Apple for this. If I put on a call credit spread, meaning I sold to open calls up here above this pivot point, and I think I'm pretty safe right there. I'm going to sell those for Halloween ish, somewhere in that time frame, the Halloween expiration, October. And they're way out of the money, but that's okay. I'm not going to get a lot of credit, but so what? I'm really safe because I'm behind this pivot and it's a long ways off and price can't hurt me. Sounds familiar, right? And since it's way out there and I'm not going to get a lot, I might as well go 10 points wide, which means I'll probably get like $2 if I'm lucky. And we'll put the trade on. I can already see some problems with this. One, we've got an earnings down here, right? That's one issue. Two, we're going to risk like $8 to collect $2. And inevitably, here's what will happen if you put on a trade like that. First thing that happens is that if the trade starts to go up, goes against you, your trade immediately starts to lose. Should you close it? We've all been there, right? We need price to stay under this pivot point right there. And as long as it doesn't go above that pivot, this trade technically is not losing. But if we had put it on yesterday, for an example, and today's breaking out and going up, at this point right here, we would already be down at least $100. Should we close it? Well, if you close it, you're gonna lock in losses in nearly every single credit spread you go to trade. So that's really not a viable option. Now we should hold it for a while and see what happens next. By the time price rises half of this distance, say somewhere in here, our trade will be down more than 50%. Should we close it? I mean, it's still under the line in the sand. As long as it doesn't close above that line by October, we're good. But we're down 50%. Nah, why lock in the loss? It's still not in the losing area. We should probably just hang on to it. By the time price gets to that area, the trade is already down more than 75%. And we look at that and say, why would I bother closing it now? I've already lost three-quarters of all of the money that it was going to lose, right? If the loss was $700 and we're already down 530, at this point, you might as well just leave the damn thing on, right? So what do? You leave it on because it's better than just eating that $530 a loss. And you never knew in that entire run, should you have closed early? Because we've all done it. We close it early, and what does it do? It falls the other way, and we say, "Dang, I should have just left I should have just left it on. Why did I even bother to close it?" And if you don't close it, and you take that loss, because the loss doesn't start when you get into the no-go zone, the loss starts immediately. So that's the problem, right? And there is no good answer to this. Tasty Trades, CBOE, the OCC, the OIC, nobody's ever come up with a good answer for this. Exactly. Damned if you do and damned if you don't. Now, we can run the numbers And we can close at stages. So, you know, that implies we put on four, five, six of them, and that once the trade gets to 40% loss, you close some. And then when it gets to 60% loss, you close some more. But again, those are still not even at the no go zone, right? They're not even above our break even yet. So we're closing a trade that technically isn't even a loser yet. The whole thing is just a really bad approach to trading. I don't like that. I wanted to solve this problem. And I did, by the way. So high probability, just to be make sure that you all understand how you even find your probability, is to look for the column that says delta, or if you have a platform that gives it to you, look for the P50 or the probability of in the money, probability of out of the money, or even just probability of touch. If you don't have any of those, I've done a video on the bullish bears where I talked about how to do the math to figure out what your probability is. We have all the information down here between how much credit am I getting and how wide the trade is. And we can use a calculator with just those numbers and we can define our probability that way. So no matter what broker you're using, you'll be able to do what is my probability. Now the thing about probability is that is what the options market has traded to this point. It's what they saw as risk. It has options support, options resistance, and options momentum calculated into it. And it has the perspective of all of the money that's in play right now. And I like that because we can say whatever we want, right? Oh, I like Apple. Yeah, I love Microsoft. Yeah, whatever. Put your money where your mouth is. And the options probability is calculated based on where money was put. And I love that. That's fantastic. So, what I like to do is focus on a high probability trade that the market doesn't see as a high probability trade. For an example, a 786 pullback, a 123 reversal on a breakout. This didn't stop at a 786, so I probably should have used a different example. That was, here's a breakout. Let's try that instead. All right. So we had Apple. It did the earnings. It ran up. It set this high. When we measured that, we got our 786 pullback and we got our 123, 111 and 123 up here. Perfect example. I knew I could find one on Apple. Just had to have a little faith. So if the options market didn't know how to run this edge, and they don't, right? We're talking quants who don't mix and match the two. Ever listen to Tom Sosnoff talk? He says technical analysis is trash. It doesn't work. Reading the candles, that's a joke. It's not real. It's all random walk. It's a waste of time, he says. Okay, great. So when I sell calls up here on that green day when we're still rising, I'm getting a high probability short in a market that does not see a high probability short. The options being traded that day would be for, 240, 245, they'd be long calls. So I like to put on trades that have a high probability for me, while the options market does not see that probability there at all. That's a little more tricky because who has the statistics for their trades, right? I know my trades are high probability. I've been trading them for years. My own trade results tell me that they're high probability. But how high of a probability is a 786 pullback? And then on what market, on what time frame, and who's trading it? You and I can both see the same pattern and trade it the same day at the same time, and we're going to get radically different outcomes. Oh, I've got Tom on video more than once saying it. He has said it more than once. I don't believe it, but you know, I don't have to believe it. It's what he has said. It's in his book. So that's one way to trick the high probability plays, right? Is to put them on before the market has priced them to be high probability. Because as soon as the market decides that it's a high probability trade, you're back into the lottery outcome with the gas stations, right? And that's what we want to avoid. We don't want to spend two to try to make a million because that just doesn't work. Or let's say that another way. We don't want to risk two to try to make a million because that just doesn't work, right? That makes more sense. So the probability that you choose directly affects how much money you're going to get. This is one of the biggest pieces of the argument for why you don't want a high probability trade. And I'll do both sides. This is the long, and it's considered a low probability trade. This long trade has a 5% chance of winning, and it's going to cost me $11. Now, I'm risking, let's round it and say 10. I'm risking $10 for a chance to make $490. Damn, that sounds good. Risk 10, make 490. But I have a 5% chance of winning this trade. If I'm willing to do the trade over and over and over and over again for the next 6 months and trade it 90 times, and I finally get that winner, would it cover all the times that I lost? If the answer is yes, then I should go ahead and get it. The problem is, most of the time, the answer is no. And so we don't want it, which is why butterflies are so high on that list, right? Butterflies are low probability trades that almost always pay way better than the losses you took most of the time. I mean, we can build bad butterflies, but so it's one of those really great opportunities to trade low risk trades that, boy, they pay good when they win. And when they lose, they're really small most of the time, right? All things considered. This trade has a 95% chance of winning. It's the same trade, right? It's just the other side of the trade. So at 90% chance of winning, high probability trade, but it's only going to make $10. You know, a lot of these high probability trade programs that you see on TV, the ones on YouTube and everything else, they say we got a plan. We want to close the trade early to cheat the probabilities. And they're not wrong on that. I'll give them credit for it. They're not wrong. If it's a 90% chance of winning at expiration, then if we cut the corner and close the trade before expiration, we can adjust the probabilities in our favor. They're not wrong on that. The problem is it's already at 90, there's nothing left to adjust. If you want to use that route and close the trade early to increase the probabilities, build the trade in an area where there's still some probabilities left on the other side, right? The 90-10, you're trying to take from the 10% group. There's not much more you can do to your trade, right? You already got the 90. But if you build a trade closer to the middle, like this one, for an example, has a 40, we're going to split the mid between those two, a 40% chance of closing out of the money. Let's see, that's a 60% win rate trade right there, 40 for 60. If we close it early, we can take from the 40 side, right? There's something left. We can increase our probabilities in this trade. We're taking a lower probability trade and making it a higher probability trade by closing it early. That works, but only if there's something on the other side of the equation, right? If it's a 90% win rate trade, there's nothing left to take. You're already at 90. 50-50, 60-40, there's something there to increase it. But let's go back out to that 91 again. Those guys on TV will say, well, we'll close it early, 50% profit. That's the sweet spot that everybody seems to like to use. When it hits 50% profit, we'll close it. You're talking about taking profit on a $10 profit trade, right? So now what? You're going to close it after $5? And then you got commissions maybe on top of that. So you end up with 3 if you're lucky. This is all around a bad trade. So this is $25 and it's a $10 wide trade. We are risking $975 for a chance to make $25. It's got a 95% chance of winning. But I can guarantee you could put this trade on 1,000 times and you could win 995 of those. But for the other 5% that you lose, it will wipe out all of your profit plus some. You won't make enough from the credit you've collected here to cover the losses when they do eventually happen. You need to get more credit out of this to run that trade with that probability. And I'm going to have to get that spreadsheet so that you can visualize that. But that's the answer you have to have, is that math. Here's my cheat to that whole thing. And it has solved the whole problem and it works really well for me. One is the visualization of, am I getting enough credit and or am I buying it at a fair price? Because we can take it both sides, right? Sell to open, buy to open. This first is what I always do. It doesn't mean I'm going to trade this one. It's what I check first. I build the trade at the money, and you can sell or buy. It doesn't matter. You can do calls or puts. Doesn't matter. Build the trade at the money, one in, one out, and look at what it costs or how much you're getting in credit. This is $5 wide. At the money, it should be half the width of the trade. Now, of course, there'll be times where price is literally bouncing on one of those strikes. So it's not going to be a perfect system, but a fair trade would be half the width of the spread. If it's blown out in either direction, I know that these options are out of whack. And we've all seen options get out of whack, right? We go in and we look. We were looking at Apple just a few minutes ago, or the Qs, and we found a 50 delta way out of the money. That was out of whack, right? So it happens. But we can't always visualize that. It's not always so simple as finding a delta 50 way out of the money. Sometimes we just need to see it in the prices. So it's the first thing I check to see, hey, are these options behaving properly? If I can build it at the money and I'm getting somewhere close to half, we're good. I can now at least start looking around. I can shop. If I was to put on a trade near the money or at the money. So $5 wide, I'm getting $2 credit. It's not bad. I would have liked 215, maybe 225 would have been a little better, but I would take it, and I would take this one. They're giving me $7 extra in the trade. I've got one in, one out. It's a 50-50 trade at this point, right? I've got a 50% chance of winning. Coin toss chance of winning. Think about that. If price is on support, my odds are in my favor that it's going to go up, right? That it will be supported. Different support for different things. It could have been a yearly high, weekly high, monthly high. It could have been a call wall, put wall. We could define support any way we want. But if I'm feeling comfortable about what we're leaning on and I build the trade at the money to lean against that, the options market says it's at the money. It's a 50-50 chance that you're right. I'd argue support says my odds are better than 50-50. I'll take that bet. So that's one way to increase your probabilities right off the bat. Build it at the money, close it early, build it off of support or resistance, however you define that support or resistance, right? When you can start stacking the odds in your favor, you can increase your probabilities. The problem is we can't define them as clearly as we can define delta. We can just straight up look at delta and be like, yeah, that's got a 10% chance of winning. What's the probability for support? I don't know. Nobody does, right? But we know that our odds are better if we trade off of it, right? We all know that. And we know for a fact if we close the trade early, we increase our probabilities that way. So I like the at the money. For one, you get a hell of a lot more money in the credit. Why get $10 credit when I can get $250 in credit? Plus, if the trade starts to go wrong, this trade was built at the money. It won't bleed as badly as that way out of the money trade. And it crossed over our break even to start to lose. Remember that example with Apple? Our break even was way up here, and the trade would only be a loser if it went above that orange line. But we would be losing the whole time it went up, and we would still not know, should we close it? Should we close it? Oh, who knows? You build it at the money, you're already seeing price cross the break even. And yet the loss is not bad. It doesn't just, rip your face off into negativity immediately. It weans its way in there. And then of course the farther away from break even it goes, the uglier the profit gets. But it starts out nice and easy. So if you're wrong, you can close with a small hand slap. Yep, yeah, nope, that didn't work. Move on to the next trade. No big deal. Don't even lose sleep on it. You put that one way out of the money, you're, making sacrifices to the trading gods that price doesn't break through that level and start running at you because you've got a wheelbarrow full of risk sitting on that thing. And it's hard to even just keep your sanity. So I start with at the money, and I'm willing to move slightly out of the money. One strike, maybe, right? Possibly two if it's got a price that I like. Like, if these strikes were $1 wide, I would be more willing to get a little further out of the money. With them being $5, one strike is about all I want to get. Even this one would monetize better. And if you're wrong, it's still a smaller hand slap. So that's my solution for probability based trades like credit spreads. Build them closer to the money. And the reason that people don't is because on YouTube, the sell is, or the pitch is, that you can make money trading options with absolutely no technical analysis required whatsoever. Hell, you don't even have to look at the chart. Who cares? And that sounds great. New traders don't know how to do technical analysis, and they hear, hey, it's all in the strikes. You just look at the numbers, play the math, trade that delta, and you're going to win 90% of the time. They're not wrong. They're just not telling you the whole story. So I say, even the barest amount of technical analysis, the minimum amount, can help you define support or resistance, call walls, weekly highs, monthly highs, yearly highs, all time highs, and that you can build the trade near the money or at the money and then run it from there. And that your probabilities are in your favor because you're increasing those probabilities by closing it early. You know what they call managing it early, and by leaning on a support or a resistance level. Those two right there takes that 50% probability trade and pushes it into the high 70s or 80s. If you did want to run a quote high probability trade, some of the rules are that you want to make sure you're getting enough money for the trade. So I've given you my spiel for why you want to be at the money or near the money and you want to use technical analysis. But now let's just go back to the standard internet high probability trade. If you want one, make sure you're getting enough money for it. Sosnoff has some rules that talks about getting 1/3 the width of the spread and being out of the money at an X delta. I can't remember off the top of my head exactly what the stats are, but give me just a second and we'll pull them up because I've got notes on all that stuff. What we're looking at here is a Discord that I built for Tasty Trade videos. Like I said, Discord is so awesome, right? I made a Discord just for Tasty Trade, and I would grab, say, something like the Jade Lizard, do a YouTube search, find every video on a Jade Lizard, and I'd throw them all in the Discord, and then I'd watch them one by one and take notes and screen cuts and edit things and, anything it took to learn whatever the topic was, like a Jade Lizard. So Tom, over the years, has done a lot of videos where he's talked about what he likes, what his sweet spot is, and how he trades things. And of course, I grabbed those too. So let's poke around in here and find where his short verticals are at. No, not the videos. We need the notes. We'll get there. Oh my goodness. There we are. Now we're getting into the notes. There it is. Short verticals. His is 45 days to expiration. Use a high IV rank. On the short leg, go for a 30 to 35 delta. And then on the long leg, run a 20 to 25 delta. Don't go higher than that 35 delta on the short strike. Yes, sir. I believe that's somewhere in here. If not, it's on the closed part. The collect near one third the width and then close near 50% profit. If the trade is losing, he likes to add a spread on the other side. He doesn't want to adjust the trade that he already has on. He focuses on adding a trade to the other side of the product. So if you're on puts, go to calls, vice versa. You are right about the days part. I'm surprised it wasn't written in there. Um, he does not like to get too close to expiration. And I'm sure I've got that written in here somewhere on one of these. Hmm. I didn't see it written on any of them. But you are right. He does not like to get too close to expiration. I thought it was once it gets below 20 days, he starts looking for an exit. Does that sound right? Right. I'll just leave it with the way he does it. You're never in the trade once it's below 20 days to expiration. That would be fitting what you just said with what I'm thinking. I remember it puts both of it in there. You should not be in the trade if it has less than 20 days to expire. That's Tom's uh, stuff, right? Now, to be fair, when I first found Tasty, I was so excited because they've got so much background and research and they've tested so many good questions over the years. Questions that I had, like how wide can you go before it's too wide? And does wider increase your chances of winning? And just all kinds of really good questions. The problem is with the numbers that I just gave and a lot of the other strategies that I saw them test, they would say, yeah, we ran the numbers and this is your optimal trade right there. And then you would go to look and you're like, I can't find that trade. Let's use Apple with this 45 days to expiration, right? So, first, let's look at the expirations. I don't have a 45. I can come in early, but that's going to really cut my nose off. So let's go to 51, right? So I have to adjust there a little bit. And he has said 45 to 60. So okay, I'm within 60. Now I need a 30 to 35 delta on the short leg. That would be 240. And I need a 20 to 25 delta on the long leg. I don't have a 25. I don't have a 20. So I can choose this next strike out or I can go two strikes, right? Make it $10 wide. Now I've got a $5 wide trade with $1.50 in credit. Do I have half the width? No, excuse me, one third the width, 30 to 40%. Yeah, I do. If you're not sure, get the calculator out, right? Thinkorswim has one built into it, and just take $5 divided by 3, $1.66. I guess I do not, right? I don't have it. For some reason, I was thinking 1.3, not 1.6. So there you go. I couldn't take this trade using his metrics because I'm not getting enough credit. And I found that problem everywhere I looked. Every time I went to get a trade using Tom's metrics, I wasn't finding what I wanted. But that's because me and Tom disagree about implied volatility, right? So let's find high volatility for a moment so we can have this discussion because my opinion on volatility is very clear that I think it's a really bad idea to hunt for things with a high IV. Flat out, I think it's just crazy. Let's start with the idea that volatility is another word for movement and implied is another word for promise. If a market promises big moves, why would you put on a trade that says, I bet you don't move? It doesn't make sense, right? Wouldn't you want to find a trade that says, I bet you don't move in a market that has a low implied volatility? Because low implied says, won't move very far at all. And you add to that and say, I bet you don't move very far at all. They are more expensive. The reason that they target high IV products is because you'll get enough credit for the risk you're about to take. They're going to pay you for that risk. They're going to give you a higher premium. So that's why people target them. And it matches the rules that we just saw that Tom had here because he's trying to solve the same problem that everybody else is trying to solve. These trades will lose. That's guaranteed. So we have to make sure we're getting enough money on the winners that we do win to covers the losers that we will get and still have money afterwards. To do that, we have to make sure we're getting enough profit when we start the trade. Now, that 50% is really important. So is the closing early part. If you don't close early, your win rate won't cover everything, right? If you take profit at 50%, you have to make sure you're closing early too, right? I know it doesn't sound like we're the same thing, but they're not the same thing. They're two different things because you can get 50% 2 days to expiration. You held on way too long. You did not close early. So if you don't, and you risk that, right? If you're risking 60 to make 40 with a 70% win rate trade and you don't close it and you're just trying to net 50%, then you're not risking uh, 60 to make 40. You're risking 60 to make 20. And that's not going to be enough money, right? So let's look at these high IV names that popped up. INO, that might be too cheap. XLI, that's a good one. An industrial, no less. XLI, one of the sectors. I didn't realize it was running in a high IV right now. So, okay, let's go out to the chart. Doesn't seem like a high IV, but whatever. I am on a 1 year. I was looking for a better visual, so let's find another one here. XLB, XLC, Sony. Sony might have it. Yeah, maybe we'll come back. Beyond Meats. Beyond Meats, by the way, did something I thought was impossible, and it changed how I analyzed companies for earnings. Back in the day, I used to say that after earnings, stocks take volatility crush. There's no asterisk to that. There was no hesitation in it. There's no, side words like maybe or could. It was at earnings, stock take volatility crush until Beyond Meat came along. It was the one company I first saw that had earnings and its IV went up at earnings, not down. I'd never seen that before. I didn't even think it was possible. I didn't know a stock could do that, but it can, and it has. And that's now changed how I talk about stocks at earnings. It was way back in the day, though. It was way back here somewhere. I'm not seeing it at the moment, but if you was to go back and hunt for the earnings, way back too, I mean, it hadn't been around for very long. That darn thing actually had earnings and its IV went up instead of down. And it just completely broke. There it is. completely broke what I thought I understood. No, that ain't it after all. About what happens to IB. So it can happen, I guess is the takeaway there. So in the current now for this one, we'll use this as our high IV example. Because the IV is so high on this, it's going to have a really good premium. All things considered, the options are juicy right now. They're expensive. We should sell to open. Kind of like going to the Kansas City Royals game at the stadium and paying $66 for 3 beers. Ouch. You could go to Sam's Club or Costco or whatever you got in your neighborhood, BJ's, and you could get a case of beer, right? For what? $8, $10? $66 for 3 beers at the Kansas City Stadium. Obviously, in that scenario, you'd rather be the one selling the beer than buying the beer. Why? Because they're so freaking expensive. These options right now in Beyond Meat are very expensive. So we should sell them. The problem is this thing is moving a lot right now, which is why it has a high V. So if we try to sell something, the idea that it could stay away from us and, end up being a successful trade is radically reduced unless you do it the way that I do it, the way I showed you guys, at the money or very close to the money. So if we went and put on, a 250, 220, 250, $2, I guess that's as good as it can get. $3 and $2.50. Look how much they're paying us to take that trade. They're just begging you to do it. That's a 50-cent wide trade. It should be 25 cents in credit. They're offering an additional 10 cents in credit there. They're jumping up and down, begging you to take it. Please, please take this. On the other side, if you was to sell the calls, nothing. That is broken. But doing it at the money showed us that it's broken so that we know when we go out of the money and we say, wow, look at all that credit I'm getting for being out of the money. Oh, that's fantastic. We should totally sell to open that. No, heck no, don't do it. It's broken. It showed you at the money that it was broken. If they're willing to give you money, don't take the trade, right? They're enticing you into it so they can slam it down your throat. High probability trades. So now you guys know how to see one because you can use delta or you can use the probability of in the money and the probability of out of the money or even just probability of touch if you want to do that. And you know how to find it, identify it, and you got some rules behind putting it on. And then you got my approach to it with the idea of going at the money. And when it comes to the at the money, my way of doing it, you don't need the 50% either, right? As we were talking about 2 weeks ago or two streams ago, your win rate is connected to your profit targets. So if you're running these at the money short plays, you can start out with something like 25 to 30% profit and just work on getting your wins first, right? When you've got a valid strategy and you're getting wins consistently and consecutively, then bump up your profit targets into the 50s or even the 60s. I rarely go beyond 65 to 70%. I think that leaves me in the trade too long and I overstay my welcome. So I do like to get out somewhere in the late 50s, but a lot of times I don't even hold it to 50, guys, because CPI, PPI, non-farm payrolls, FOMC, all these other things that I look down the road and I'm like, oh dang, there's this coming and then there's that coming, and I just close them at 25, 30% profit. When it comes to these at the money trades, the max loss is the other side, right? So if it's a $5 trade and you collected $2, then 3 is the other side. You can always define your risk. In fact, this is actually something that I'm in a discussion with developers right now on another project, how to define the percent of profit or loss, whichever way the trade goes. And we're actually arguing about this with the CBOE, the OIC, the OCC, like everybody's in the conversation right now. This is a $5 wide spread, right? And just to make some easy numbers, we're going to sell it for $3. So there is $2 at risk. If we published this to social media and we say we're going to take profit at 50% and we're going to close the trade at loss at 50%, 50% of what? Well, the profit side's pretty easy. I collected $3. 50% of that is $1.50. So the profit side's not really an issue. But what about the loss side? That's where everybody's having this big discussion right now. $2 is the max loss. If I was going to close at half of the max loss, that would be $1. In theory, that sounds great, but it's a $5 wide trade. And the way that we refer to these is it's a $5 wide trade. The most that can be lost is $5, because first you give back the 3 that you had already collected, and then you give back another dollar on top of that, and then another dollar, and then that's your $5. So if we was to post on social media, hey, I took a trade on Apple, got $3 in credit, let's close it at 50% profit on the winning side, and if it starts to go against us, let's close it at 50% loss. How does the person reading that post know what 50% of the loss is? Is it half of the $5? Or is it half of the loss that could have been lost dollar wise, which is the 2? Because in theory, this trade is going to lose $5 if it's wrong. And if we held all the way to expiration. I don't have an answer to that, by the way, but neither does the CBOE and the OIC and all the rest of the guys. So, I mean, damn, if they don't know, right? And I get their legal argument is it's a $5 trade. Yes. So if it's a $5 trade and we're going to close it at 50%, then we need to be closing it at 50% of the max, and that would be at 250. Well, if we closed it at 250, that would be profit, right? That would be $50 profit on us. So what we have to define is we wouldn't even use 50 anymore. We'd say, well, I really just want to buy it back as a loser at $4. That's the answer that we're all looking for. I want to buy it back at $4 if it's losing. Okay, well, what percentage of that? Marziti, you want to put the math on there? $4 is what percent of $5? Exactly. The way that I play these, with them being near the money or at the money, it really helps solve a lot of issues when it comes to having enough money for commissions, the ability to actually roll the trade or adjust it or modify it. If you're way out of the money, your chances of even getting that fixed are often really low, right? If it starts to go against you, um, you really, a lot of times, you don't have any recourse because it's either still really far out of the money and you just can't get any liquidity, or it's now moving towards the money really fast and everybody's trying to do what you're doing and you can't get a good price on it, and you just can't get it fixed unless you're willing to add money to the trade, which I don't like to add money to losers. So if you build it near the money or at the money the way I do, and it starts to go against you, your ability to roll it or add to the contracts, or just add to the other side to fix things that are going wrong, are so much better. It's not to say that you'll be able to. I don't want to make it sound like you'll always be able to fix these trades, but I tell you, when I go to build a vertical or any options trade, really, to be fair, one of the things I'm asking is this a trade that I'm actually going to try to fix? Because some trades, when I put them on, I know when I'm putting them on, I'm not going to come in and fix it. If it starts to lose, I'm either going to close it or I'm just going to let it go and leave it to the options gods, and that I won't fix it. But if I look at it as I'm building it and I think, yeah, no, I'm probably going to fix this one if it goes against me, it changes the strikes that I choose, the expiration that I want, because if I'm willing to fix it, I'm going to need time to fix it. I'm going to need to know that I've got the additional uh, liquidity to fix it. So it becomes an issue of concern. And so hopefully, this discussion on probabilities has now solved that issue. You really don't want a high probability trade as it is defined in the options world. You want to define the high probability trade before the options world ever sees it as high probability. And that way the odds are in your favor, right? So there was a question about, not even a question, really. It seems like there's a discussion about what, mortgages? I would think that his exposure to interest rates because of mortgage rates would make him a good candidate to focus on fixed income, which would be more of the corporate bond side of things. At least when I think bonds, I think corporate bonds. They're going to pay you better premium than government bonds. Yeah. Well, I mean, that we got a couple of different routes to take. One, his exposure to mortgages does not mean that he has any background or concept of bonds in general, government bonds more specifically, things like Freddie Mac, Freddie May, any of that. But when I think of anybody in the real estate place or dealing with mortgages, then bonds do come to mind. And corporate bonds are better than government bonds if you're looking to make money, right? They are more liquid, they pay you better, you have more choices. So I just brought up corporate bonds, Nvidia, Amazon, Apple, Meta, Microsoft, Google, AMD. All of these guys need money, right? And they want to take a loan out, but they're going to just sell you bonds. So these are your bonds to shop around on. But that's solely fixed income, right? You're not quote trading necessarily. You're just loaning them money and you're going to get paid a nice dividend from it. That really isn't the word I need to use there. You're going to get a nice premium from it, right? And you're just loaning them money. Really, that's all you're doing. And it's a safer way to participate with your money than leaving it in the bank. Obviously, if you don't spend your money or even put it out there, that's the safest, but you won't grow, right? Your bank's offering one and a quarter, 2%. If you get a bond on Nvidia, they're offering 5.4. There's thought I saw 6 a little bit ago. Maybe it was just because I was moving the mouse. I didn't see a 6 there. But you can choose who your issuer is, what kind of yield you're looking for. It's its own entity. So, you got like Webull, Robinhood, IBKR, Thinkorswim, Public. It's its own brokerage, right? Um, I found these guys on my phone first, and then later I found out that they had a web presence as well. I love this. My family and extended family do not trade. And yet they're always asking me things like, what should I buy? And then they don't listen to a damn thing I say. So I pointed them towards this, and it's great because on the app, it will guide you into things. They have thematics that are already built. They handle the entire transaction for you. You can do fractions of a single share if you want. This thing is just all around really handy for people who are not traders who want to get into the market. And it's a really good way to go. Um, that would be if we wanted to keep it in his wheelhouse, there is something like corporate bonds. And that's the first thing that came to my mind when I seen the question would be loaning money to the big dogs. They pay well, you know. They pay better than the banks anyways. Is there risk? I mean, yeah, Apple could say screw you, you know, but is that likely? No, it's really not. You know what I mean? It's really not likely to see that sort of behavior. So as long as you're running with a double or a triple A bond rating, you're good. Now I'm sure I could find some, C's and D's with a higher yield, but now I'm getting into some, you know, riskier stuff. Yeah. They need a little money. Yeah. No. Well, they have the right to close it early, right? They can pay it early and close the whole thing out, and you have the right to get out early. And it will be structured. Each each one of these has their own time frame. So I can't say off the cuff that it's quarterly or whatever. I'd have to go in and you'd have all of us would have to go in each time we go to trade one of these corporate ones to see, what's the time frame here? When does it calculate? And it may just calculate based on how long you held it. If it closes in 2027 and I hold it for a month, then maybe they give me X amount of money, for that time that I held it. The thing about this is that it very likely isn't going to tolerate a lot of in and out, right? They're not going to. I've seen managed ETFs that will lock you out if you keep jumping in and out of those managed ETFs. They want you in with a set time frame of like at least 3 months. And if you're rotating in and out of those fixed ETFs, they'll tell you get out and stay out or get in and stay in, right? They get kind of pissy about it. But, when it comes to return on capital, corporate bonds is not a bad way to go. What got me curious, though, when you mentioned that we have a guy in the community who is in that space, was how much knowledge they had about things like junk bonds or, HYG, JNK. Because when I think bonds, I do go look at HYG and JNK. Those are my two go tos that I like to go look at. But at the end of it, though, the knowledge that he has on mortgages and financing or refinancing isn't going to equate to a tradable strategy by itself. That's the sad fact is that it won't translate into tradable opportunity. Not now. Maybe after he's been a trader for a couple of years, he'll be able to take what he knows and tie it into something where he can trade Open and Redfin and Rocket because he'll understand within the sector that he works what's happening to mortgages and why Rocket Mortgage would be good next quarter or bad next quarter and make trades based onto that. Kind of like how when I worked in the oil field, I could see the costs were going up or costs were going down. I could see when different sectors in the oil field were running out or that a lot of wells needed to be worked over, say in the Permian Basin, and that there would be a lot of oil companies that were in the Permian Basin that were going to have to pay a boatload of money in the next 2 years to rework their wells. Those companies were going to get hit for the next 2 years. They weren't going to be good stock buys. I had insight based on where I worked about a particular sector or industry. So in 2 or 3 years, when he's been trading for a while, he'll be able to use the knowledge that he has from working in the housing space to better trade housing company stocks like Open and Rocket and Redfin and you, you did touch on something that I've always taken for granted that I know a lot of people don't. If you're just getting into trading, you absolutely should look at stocks that are in your wheelhouse, right? Like they always say trade what you know. When I started trading, well, I didn't know anything about trading, but I was a computer guy even back then. The first thing I ever traded was AMD. Why? Well, I knew what the hell it was, right? I didn't know what SPY was or the Qs, and everybody was talking about the SPY and the Qs. I'm like, I don't know what the hell that is, but I know what AMD is. I traded what I knew, right? There is a seasonality on Thinkorswim, absolutely. It has been a while, so give me a moment to find it. But ah, oh yeah, 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 yeah. That's style. It's been so long, right? Since there it is, seasonality. So I've let's go to something like SPY, right? SPY is right now up here. It's 646.8 and seasonality down here in red, right? So this is what we've done so far this year, and this is generally what we typically do. Now we can adjust those settings somehow. I believe I had a look back adjusted at. I had a whole chart set up on this, and I bet I still do somewhere. Think Thinkorswim is one of those all around platforms. See all these that say Fred? You've got government data built into it, like the job numbers or the interest rates. We've got mortgage rates. You'd be surprised at what's in this thing, including seasonality and government data. So if I go in and look at the Fed's fund rate, right? We know that chart when they cut because of COVID, when they started raising rates because of runaway inflation, and then they started cutting, and now they've been holding rates steady. And that's a chart right on Thinkorswim. You know, and I've seen people say they want this stuff and that they go to like stockcharts.com or TradingView to get it, and it's right there. The problem is Thinkorswim is such a vast platform that you can get lost trying to find it all, right? And even me, I knew it had seasonality. I forgot where it was because I haven't used it probably in a year. And if Marziti hadn't have given me the shortcut, we'd have still been digging for it. I'd have got there eventually, but there's just so many pieces to this platform. Still really good stuff though. There was a comment about being very careful about trading with insider knowledge. And I've had this situation. One, for anybody who doesn't know, I've got a degree in psychology, and you can, if you get licensed, your license can be taken away for even the shade of impropriety. You don't actually have to get caught doing something wrong. If you have the implication that you did something wrong and it shades your name, they can pull your license, right? So they're very particular about who gets a license in psychology. And anything that remotely resembles any sort of impropriety, you have to just stay the heck away from it. I was working at Foot Locker and they were going to redesign their selling system to be like an Amazon type platform, an app that you could trade and buy shoes. Trade was a big deal. People, I didn't realize, but people trade shoes and buy shoes that have been used, and then you got your new shoes. Oh, it's wild. But they also they also had to rebuild their entire shipping facility. It's in Junction City, Kansas, and it's a global distribution system. Well, they were working on it and something broke somewhere between the logic that the system used and the machines that were running inside the company. It all went to hell. And they paid us to come in every day and sit in the break room. If you wanted to go outside and smoke, go outside and smoke just because that was also hidden from view. But you had to show up, you had to be there, you could not go home early. And they didn't care that you weren't working because they needed you on the facility. Why? To keep up appearances. They didn't want anybody to know that they weren't ready to go and that they were paying all of these employees to just sit on their hands and not do a damn thing. Well, I'm a trader. I knew what that was going to do to their earnings. You know, it was very clear that their earnings were going to go to hell. I couldn't do anything about it. I couldn't trade it. I was, what do you do? So I couldn't. Yeah, my friends could have traded it, my wife could have traded it, but it was just one of those situations that, I clearly had insider information about what was going to happen. And, I could even make the argument that you might think you know what's going to happen at earnings, but you never know. It can be the worst earnings ever and they can still go up as long as they make that earnings sound good. So maybe I could have traded and still had quote risk, but I didn't. I didn't want any hint of impropriety or any comment about insider trading being attached to me in any way whatsoever. So I didn't trade Foot Locker the entire time that I worked there, and for months after I quit working there, I didn't trade them because I didn't want to be connected to any sort of insider trading at all. And if you work in the financial space, it's got to be just as bad, right? Yeah. I want to, yeah, in the last, I'd say in the last 3 months, I've had 10 people that are really new to trading reach out to me because they wanted coaching. And I get it, right? I get it. You think that having a coach when you're really new is going to help you navigate some of the roads that you have to take. And to be fair, you're right. But you don't want to pay my prices for new info, right? For like new person trading info. It's not worth it. If someone charged me my prices to teach me intro stuff, I'd have been really mad, right? So I don't take clients as coaching clients when they're brand new because I'm not cheap, right? And you shouldn't pay my prices for what you're going to get, which is new material. There's so many really good places where you can get new material for free. Doesn't cost you anything. Schwab is one of those places. They've got a lot of data. It used to be Thinkorswim that I would point people towards, and you may still find old Thinkorswim videos that can be helpful that are from the Thinkorswim platform group. But Schwab has videos, entire video streams, right? Like we're talking video series of how to do technical analysis. Enter, yeah, playlists. They've got technical analysis, how to do trading, day trading, swing trading, how to understand uh, different economic events. Now, this is just one example, right? I went to Schwab, but there's IBKR, Robinhood, Ninja Trader. Schwab has its own TV show. They have a chat room on the platform, on the Thinkorswim platform. They have people that used to work at TD Ameritrade who now work at Schwab, who live stream every single day. They have a topic that they post in advance that they tell you, hey, on this day at this time, we're going to talk about this topic. And it is a really great way to learn how to do all sorts of great stuff that, from a beginner's point of view, you want to go look around in their files and see what you can find. They've got playlists on everything. I For a while they turned them all off when they first did the merger. I don't know if they turned some back on or not, but like Thinkorswim, no, the TD Ameritrade YouTube went dark for a little bit. I don't know if they still have their YouTube back or not. Now, see, that makes sense because when TD Ameritrade was around, they had 5 different YouTube channels. TD Ameritrade used to have 5 different ones, and one of them was coaching, one of them was trading, one of them was futures, one was for economic events, and one was for their TV. You know what I mean? Like they had so many different ones, and now Schwab doing the same thing, not a surprise, right? So if you're looking for Schwab, make sure you realize that Schwab has more than one YouTube. There's the Schwab Network, which is probably what I was on earlier. That'd be their TV show. So the point is, doesn't matter that it's Schwab. All of the brokers out there have educational stuff, right? So you can go to IBKR, you can go to Schwab, Robinhood, Webull, find the YouTube channel for that broker. Because I've had people say, well, I don't know who to trust. If it's just some Joe Schmo in his mom's basement making videos, how do I know that he's legit? I get it. And I'm not asking you to go and trust those. You can go to the broker that you use and look at their education. Go to their website. They've got published articles that talk about more complex things. They can teach you about price action, reading candles, keep you up to date on current events, right? It's free and it doesn't cost you anything. And then you have the bullish bears to ask questions because you do need guidance. I do get that. You know, when I was new, I needed guidance too. That's how I found the bullish bears. So You have all of us moderators and other members in the community so that if you're new and you want to know what's next or you want a direction or help with guidance, ask it in the chat because you're not going to get those answers from Schwab, right? They're not going to know, but we're here and you can ask us things and it won't cost you the cost of what I charge for coaching. So that way, you get the best of both worlds. You get the guidance you need, you get pointed in the right direction. And when it comes to trading, I've always said it's about education, right? You can't paper trade your way to success, which means you have to know where the resources are. YouTube is one of those resources by using these brokers. I'm pointing that out. And then, of course, their web pages. Those are other resources. But then, if you're getting into options and you want to know more, I keep seeing these $10,000 classes for options. What a joke. You can go to the OIC, the OCC, the CBOE, the NASDAQ website, and you can get options education for free. You can go to Tasty Live. They've called the Lunchbox. They've got really great options school there from A to Z with questions and reviews and all sorts of stuff connected to it. I said Lunchbox, but it was Luckbox. Tasty Live Luckbox. And it's all free. It doesn't cost you anything, right? So you don't need a coach if you're new, right? That's the main takeaway. Would it be nice to have? I mean, heck yeah, it would be great, but I'm not cheap. So, I tend to say no to the new people because you don't need me. You really just need some guidance and you can get that guidance right here in the Discord. In 7 minutes, we're going to be done for the day, and then we're going to see what we're going to get from NVIDIA. Now, I mentioned this morning that it was possible the market says, forget NVIDIA, we're going to make a run for it. That's Friday's high, right? No, that's not Friday's high. Yeah, Friday's high. It's the 22nd. We broke out of Friday's high and made a run for it today in the SPX. And I posted in the chat about the Vanna. They cleared out that overhead gamma and they cleared the way for us to make a run for it, right? And we're making a run for it. The options guardrails were removed, which is fantastic. But that does not mean that they know anything about NVIDIA's earnings that we don't know, right? See, and that's crazy. I I seen an options school near me, and it's in Kansas City, Kansas, and they have like a $12,000 trading course. And if you take it and you're still confused, you can take it again for like half price. And if you do that and you're still confused, I think they let you just have it for free after that because they figure, yeah, you're not going to get it, and they just let you have it. But you're basically out like you know 18 to $20,000 before they finally, and that's not even everything they have. That's just their trading class, like welcome to trading 101 kind of stuff. Then they break down another area for options and another area for futures, and it's crazy stuff. I've seen their table of contents. I haven't seen the material itself because I ain't paying to even take a peek at it. But I've seen what's in the header and what's in the table of contents, and nothing they had was worth that money. We absolutely could. The downside of it is the the cost, right? I won't do it for free, but on the other hand, I can't see charging people $12,000 for it either. It's a crazy world out there, and there's more and more of them every day. I thought there would be less as the public becomes more easily able to find the information. I thought for sure that those places would diminish, and they're not. They're growing. There's more of them every day because people are willing to pay it. Boggles the mind. The sad thing is even after they're done with it, it doesn't mean they're proficient. The one that I know about in Kansas City, I found out about it because after a person had been using their services, meaning they paid the money, they showed up here at the Bullish Bears and they were telling me about it. And I was like, oh, wow, that's near my house. I mean, it's like 200 miles away, but still, that's near me. I didn't know there was anything trading in Kansas. And they had made it through all that material and still needed the Bullish Bears afterwards. Yeah. So we got our melt up. Um, whether or not we keep it, I said this morning in the live stream, I think Nvidia is going to do good. My concern though is this 15% kickback that they've offered the government, right? Or that the government demanded, however you want to say it. Remember, the Nvidia and other chip companies are going to start paying the government 15% for the privilege of exporting to China and other places. What's that going to do to Nvidia's bottom line? And are they going to be able to cover that and still meet the street's expectations? I don't know. I have no doubt they're going to have a really good earnings. My fear is that it just won't be good enough for the expectations that the street is looking for. So, oh yeah, there's been a lot of talk about how China had workarounds. That's funny. Well, that would explain their comments about backdoors into Nvidia chips, wouldn't it? 'Cause they made that comment last month when they blackballed the Nvidia chips, right? They were putting out statements to their to Chinese companies saying we don't want you buying Nvidia chips because there's a backdoor. And Jensen Huang had to come out and say there's no backdoor in Nvidia chips. What are you talking about? Well, that's absolutely ludicrous. So now we know the backstory to that, which is pretty cool. I didn't know. That's funny. If the earnings go good today, I know everybody's got this expectation that if Nvidia's earnings are good, we're going to see this big blowout in the markets and we're going to really go higher from here. I want to add a little bit of caution on top of that and say, yes, but be careful. Um, Powell did not introduce the idea of cutting rates to normalize. He introduced that because he can see weakness on the horizon. We've still got really strong CTAs, but we need to see how much money the corporate side is going to come in. And that is 3 weeks away ish, right? And we still need to see some GDP numbers. And the corporate issuance that's coming out mid September should be more than enough added or combined with the CTA positioning and the stock buyback to keep us going into the new year. Should be. But if Powell's pulling forward risk, the markets might start pulling forward risk. And we're entering into the seasonality where we expect to go down to sideways anyways. Labor Day weekend usually kicks off a selling period. Uh, Good or not, with Nvidia, we could go down from here. And I'm not talking about, selling off to 5,000. I'm not talking about a 2022 bear market or anything like that. I'm saying that maybe 7,000 isn't on the table this year, and that for the next month or so, we could fade back very similar to what we had back here in June, July, or what we had from October to February last year, right? Where we just did this and we didn't get anything done. It's that time of year again, right? Look at September, we had that Labor Day sell off right there. That's the Labor Day sell off that I'm warning about, right? We're going to come back and see this recording. It's that day right there that I'm warning you guys about. But that was one down day or one down week, I should say, because it's a weekly chart. And then we went up for, a couple more weeks, another month and a half, and it kept grinding. And their volatility is projected really low. This is the lowest volatility they've projected since the IV, not IV, since the AI bubble began back 2 years ago, right? This earnings right here has the lowest IV, which means the lowest expected move since it started the run. Okay. So, add that to but it always runs when it beats. I've got some stats that argue against that too. Remember, I mentioned at the start we might do an earnings chart. I'm willing to share this chart too, guys, by the way. I don't bring it out very often because it's really noisy and it's really ugly, but it is a really handy chart when it comes to earnings. Here's NVIDIA. I'm going to just tighten it up for a moment so we can see the labels on the top. We are looking at uh, 8 quarters, 8 earnings. NVIDIA's got a 21-day pre-earnings ramp of 10%, and it has a post-earnings rise of 1.2%. Out of 8 earnings, it had 3 earnings that were greater than 5% within 8 days after the earnings. That's 3 out of 8. And it had 3 that were bigger than 5% within 8 days to the downside. So that's 6. 6 out of 8 earnings were moves greater than 5%, up and down. All right. So when I share this, you're going to get the whole thing with all the indicators already intact. Just the way that you see it is the way that you're going to get it. So you don't have to worry about adding any indicators. But when I share a chart this way, the indicators will have the word share behind them. So you're going to want to go in there and open it up and remove the share word behind it and just, call it earnings hot zone and earnings volatility. That way you can find them again. And I will put this in the chat. Earnings chat. Wrong word. There we go. Yeah. So what this gives me, and one of the reasons I like to look at it for earnings, is the numbers behind its earnings. And you can put as many years on there as you want. Obviously, as much as the company has. So if I went back 56 times, it wouldn't do me any good, right? Because we want to look at NVIDIA when it really started to do the whole AI thing way back here. And that's only, 2019. So I don't need however many years, 15 years. We only need 10 years, right? Put 10 years on there. That ought to cover it. Actually, less than that. Let's do 8. I go 5. Five's too short. 5 gets it. That's 18 earnings. It's missed twice in 18 earnings. And now the ramp is almost 9%. When it's a 21-day ramp of 8%, it's an 8-day ramp of not even a half of a percent. So that 8-day warning, what it tells us is that NVIDIA has a history of going sideways the week of its earnings. What happened is, though, when it got really big, it turned the market into going sideways for its earnings, right? Like the whole market goes sideways. And not every earnings. If you guys notice, we weren't this hung up last earnings or even the earnings before that, but this is a big one, right? It's a really big earnings event for NVIDIA, and they're not always so big as this one. But it's not the first time that NVIDIA has captured the whole of the market and held it hostage, which is why it was easy to spot it last week when I warned everybody, hey, next week we're going to go sideways into NVIDIA's earnings. We don't always have such a nice leg up as this. Sometimes, it's a surprise and we just don't see it coming or we don't have enough information. We were able to we were given an opportunity to make a lot of money by recognizing that it was a sideways earnings event. Hopefully you guys took advantage of that and monetized it. The chart has these lines here. They're orange and gray. I color coded those to match the labels. Here's the market maker move. That's those gray lines. And then here's the one standard deviation move, and that's those orange lines. Now, the way I ran the math is first it calculates the one standard deviation, and then it adds on top of that the market maker move, which is why they're farther away. Other people do not do it that way. They'll look at the market maker move and they'll say, "Oh, well, that's the move." They'll ignore the one for the other. I disagree with that. Add the two together. That's your move. So if you was going to play an earnings iron condor, or if you was wanting to build butterflies on the edges of what you thought was the earnings expected move, you would want to target the addition of the two, right? Add them together because that's your real IB. I, isn't that nuts? I think when they look back, they're going to call Nvidia a widow maker. Hey, did anybody know what's up with PayPal today? They were having issues since this morning. No, I mean I can go research it. I never got a chance today. I was busy, so I didn't get a chance to go look. I was just wondering if anybody knew off the top of their head what was going on with PayPal. Look at that move, huh? That's a liquidity gap, and it ran right back up and closed the gap. You gotta love that. It's like on Madagascar when they're all out there singing. You gotta move it. I like to move it. The grandkids love that show. So we got a lot covered today, but I gotta say the probabilities talk, since we did not go into how the probabilities are derived, you may not trust that those probabilities are accurate. And it is such a deep conversation. I didn't go there today, but I have resources that I think could help explain why those probabilities can be trusted. And if you still don't trust the probabilities that are there, I can dig those resources up. I would also recommend that you do check out the Bullish Bears. Um, when they hired me to make content for the Bullish Bears, they had asked that I do the advanced options material. And so I did. But unfortunately, there's a big gap between the intro stuff that they did and the advanced stuff that I did. They had told me at the time, "Don't worry about it. We're going to fill in the gap," and they did not fill in that gap. There's still a very huge gap between the two. But I've done two schools right here in the chat. Right, we did them like every Tuesday for months, and I wrote a PDF that went with them. One of those schools got put into the next level library, and it was called something like the options class, advanced options class, something like that. And it's on the website in the next level library. The other one was the introduction to options class, and it's on our YouTube. I've shared the PDFs in the chat, so if we have to, we can run a search and dig them out of from wherever they're at. And in the intro class, we went through a lot of really good stuff that I don't see taught in intro classes anywhere else, even on the Bullish Bears website, which is one of the reasons that I did what I did to begin with, because we didn't have it in our own, intro to options course. Advanced, I think he called it advanced options strategies. Yeah, there it is right there. Advanced option strategies. This was done in week after week right here in the Discord. And then there's like 20 videos on the IV school. I could have done another 20 videos on top of that, right? When it comes to IV, there's just so much. And the more you understand about IV's impact on options, the better. But that's a lot of content to work through. And it's worth digging into it to better understand advanced level trading. But remember, this is the part two, this is the advanced stuff. So on the website and or on the YouTube, use the number two. So intro to options, bullish bears. and you'll find the Introduction to Options class. This is the full playlist right there. And the PDF is in this chat somewhere. So we can, you know, run a search in the upper right corner of the Discord and look for, intro to options with the number 2, and you should find that PDF document. I believe at one point I started to add to it and to rewrite some of it, but life, I got distracted. I don't know. I seen something shiny. Ooh, squirrel. This is SIG style Introduction to Options version, which I think covers more parts and pieces to options that is relevant for people who actually want to trade them rather than the theory and the logic behind them and that sort of thing. If you want background on that earnings chart, I mean, I really don't have a lot to it. Hopefully, you've seen that I scrunched it all together when we first looked at it. That is really helpful to start the whole thing, right? So if you scrunch it together, you can see how many quarters it's looking at, how many beat versus how many missed. Pre ER is before earnings. Post ER is after earnings. So it's looking at 21 days before, 8 days before, 8 days after. Then how many were up moves within 8 days? So it reports and it's looking at the next 8 days after the report. How many times did it move less than 5%? None. 8 days after earnings, how many times did it move more than 5% to the upside? 6. 8 days after it reported, how many times did it move to the downside less than 5%? 1. After it reported, how many times did it move to the downside more than 5%? 1. 6 plus 2 is 8. That's the 8 earnings that are analyzed. And that's how we read all of those labels. So that's the labels part. Then when we open it back up, we've got these shaded windows. Let's just zoom into this really colorful one here. The cloud is showing you the 21 days all the way up to the 8 days. And then from the 8 days all the way into the earnings itself. So that's what those two clouds are. And then 8 days afterwards, it's got that cloud as well. So that's the three clouds. That matches the labels that we were looking at: 21 days, 8 days, earnings, 8 days after earnings. Then we've got the market maker move and the implied volatility or the expected move. Market maker move and expected move are two different sides of the same kind of coin, looking at what the options statistics and implied volatility suggests for how far we could move with a plus and a minus. This is your implied vol average, and this is the market maker move. So if those are present, which they almost always are when a company has earnings, then it'll have those on there. So we come back out to this chart. If I put NVIDIA in there, you'll see that it has the market maker move and the one standard deviation move. That's your expected move. So that covers all of the labels and the lines that are up here and these zones that we see in color. Then we have this down here. Now that's just IV, right? If I bring up another indicator and just use Thinkorswim's implied volatility, it's the same number, 0.4772. 0.4772. They're exactly the same thing. The only difference is that it's color coded. When we're in a low vol environment, you should be buying options. When you're in a high vol environment, you should be selling options, right? Red, sell, green, buy, yellow's in the middle. It's not high, it's not low. So it's just IV. It just happens to have pretty colors. And then it's giving you the rank as well as the IV itself. Because IV leaves us wondering, right? If we say, oh, wow, NVIDIA's got an IV of 48, is that high for NVIDIA? Shoot, I don't know. Well, what about SPY? If SPY had an IV of 48, would that be high? Well, heck yeah, right? The market would be melting down. We'd be crashing and burning with a 48 IV. So we need to be able to put that into context, right? When we say a company has 48 IV, we need to be able to put a gauge on that and say, well, for this company, is that a high IV? And that's what rank gives us. In relation to NVIDIA, IV at a 48, no, that's not high at all. That's only in the 22 percentile. That's kind of low for NVIDIA, all things considered. So now you know how to read that chart. So you got your IV down at the bottom, your 21-day, 8-day, and 8-day windows, then the gap labels, and your earnings information at the top. And the best way to read those labels is just do what I did right there. Scrunch the whole thing up so that you can read them line by line rather than reading them like a paragraph. That's to be expected. Even if it was good earnings, it would have dropped. 172 is the key line on NVIDIA for its monthly and its weekly levels. For me, for August, closing above 172 is really important, or closing below 172 becomes really important. And I'm not talking about just wicking down there today and closing below. I mean, getting down there and staying down below 172 is going to be a really big deal. So that's the line in the sand on NVIDIA, 172. That it would beat, that it would have a good earnings and that it would beat. And as I said in the morning briefing, my success rate at earnings is almost 100%, that I'm nearly always wrong. Not right, wrong. And that my bet was we would go up, that it would beat. And if I'm wrong almost 100% of the time, that means the expectation is that it goes down. I'm so bad at picking earnings directions. That's why playing the straddle or the strangle is always the better choice for me, or playing those windows. Well, I know my statistics. I know my trading stats. That's the word I was looking for, stats. I know my trading stats. I have a very, very high number, almost 100%. That's a high number, bro. It was funny. I was talking to a trader once trading futures, and he was so frustrated. He's like, I have a losing rate right now of nearly 100%. And I said, that's impossible. You can't trade futures and have a loss rate of nearly 100%. Like a coin toss alone should get you somewhere in the 50s, 50% win rate. How are you nearly 100% wrong? And he said, not nearly. Every trade I take is wrong. Every trade. He was really upset, as you can imagine. He was losing every single trade. Like something is wrong because I mean, even on accident, you should win once in a while. And we went in and looked at his trades because he finally started journaling his trades. He wouldn't journal them, so I didn't know what he was doing. Went in and looked at his trades. He was dyslexic. He was reading the candle analysis completely backwards. So he was doing it right, just 100% in the wrong direction. Once we solved that problem, he was kicking butt because then he went from 100% loss rate to almost 100% win rate. It was really interesting. That's where I found out that dyslexia in candle reading is actually a real thing. I had no idea. Who'd have thought, right? Wow, that's crazy. Well, guys, we made it through. As usual, if you have topics that you want to cover or trades that you want to review, markets that you want to look at, hit me up in the chat. I always love having a topic to focus on for our sessions. And if you don't have something, don't worry because I'll always have something that we'll cover. At this point, I'm going to wrap it up unless you guys got a question on anything we covered today, and we'll get the evening started. Absolutely. Yes, it is possible to be a successful futures trader. The only ones I've ever seen that don't end up successful are the ones that quit doing it. Everybody that I know that has stuck with it has become successful at it. Futures do not have to only be day traded. So, no, if you still struggle at day trading, as long as you're a successful trader, you could trade futures. They don't have to be strictly intraday traded. Trading is trading, right? It doesn't matter that it's options or futures or stock or baseball cards or rocks. Doesn't matter what it is. Absolutely. Around 130, give or take 10. Yes. Yes. That's down. That's less than my norm. Normally, I'm running in the 180s, 220s, 250s, and a lot of those have already done what they're supposed to do. I don't even need to look at them anymore. I can't lose on them. I've rolled them or adjusted them or locked them in a way to where they can't cause me physical harm. So I just let them be, right? And maybe I go in and try to roll them and see if I can get a little more out of them, a little squeeze. But if I can't, I just ignore them. I forget about them, and then I get the email that says that trade closed or this one expired. I'm like, oh shoot, I forgot all about that thing because it's no longer even a threat, right? That if it's not a threat, I don't care, and I go open another one. You know, that's my alpha protocol. I have that. Yeah, I have that strategy. Yeah, in all three products, they can all be traded day, swing. So if you don't like to day trade, don't day trade. If you don't like to swing trade, don't swing trade. Stocks, option, futures, doesn't matter. They can all be traded that way. What matters is what resonates, right? So a lot of people ask me, hey, what should I do? And I turn it back on them. What can you do? Because I've had people who say, I suck at math and I will not learn. Well, if you flat out or just refuse to learn, then stay away from options, right? Because you need a lot of math to trade options. And I've had people say, I'm willing to do whatever it takes. I'll grind as far as I have to grind. Then the sky's the limit, right? Try to gravitate towards what suits you best. To me, that was stocks and options at first. They suited me the best, and I gravitated in that direction. Of course, you learn price action no matter which choice you make. So, or I should say, you would want to know price action no matter which choice you take. So, in that regard, learning price will give you the flexibility to trade all three eventually because, it can get you there. You can trade options without math. It's just a lot more difficult. And you're handicapped, you don't get all the fun stuff. But you want to focus on whatever suits your needs. If you're working a full time job or you're a stay at home parent with kids, that's a full time job on its own. Maybe you can't pay attention to intraday price. Great, you're a swing trader. Maybe you're ADHD and you can't hold on to a trade more than an hour. Great, you're a day trader, not a swing trader. S- Just build what suits your life and go from there. It always comes down to you have to personalize your trade approach. Nothing that anybody is doing right now will work for you. You'll have to take it and make subtle changes to tweak it and make it uniquely yours. And until you understand how to do that, you can't become successful, right? Because there's no cookie cutter approach to trading that you can just take somebody else's style, make it work, and stay successful with it. I have never seen that work over the long term. I've seen it work short term, but over the long haul, it doesn't work. It has to be uniquely yours. Even if you just change one little piece, it still makes it yours because it's the understanding of the approach to that trade style that eventually gets you to the point where you understand the dynamics and when to pull the trigger and how to manage the trade. Everything we do in trading has to eventually boil down to how did we get to where we are and where do I think we're going next? That comes from education and from understanding price action, not from cookie cutter approaches with lines and levels and indicators and techniques. And it comes from understanding market forces. Where did we come from and where are we going next? So keep the faith. You'll get there. I've used the analogy that learning how to trade is like sitting in the middle of the ocean. You're swimming and you're looking around and there's absolutely no land in sight. You have no idea what direction to go in and you have nothing to stand on to get your footing. That is the introduction to trading. Unfortunately, while you can, maybe see some glowing light in the distance, you still have to get input from others, right? You have to ask questions and get some outside influence, which is why the bullish bears is nice to have around. Because while I keep saying it's on you to choose, sometimes we can't choose until we know more about the choices, right? And that's what we're here for. Ask questions, get input, let us help guide you to where you need to be. But at the end of the day, you still have to choose, right? I've never been able to tell somebody, well, okay, you need to go do this and you need to go do that. You guys got to choose, but we can help you make that decision. So ask us questions, keep showing up, keep trying, because the only people I've ever seen fail are the ones that quit. And it just takes some of us longer than others. Futures are such a game changer with small accounts. When I started, you didn't have a choice. If you had a small account, you had options or stock, and that was it. And futures changed the game when they came out with micros. I was so excited for the launch day on that. Man, every day I was talking about it in the live streams. Like, we got one more week and then we're going to be live with these micros, and then it was 5 days and 4 days. Like, okay, this coming week, we're going to be live at the micros. Yeah, the whole world changed when we got those. Now that's the best way to grow a small account is futures. All right, everybody. Have a good evening. I will see you all in the morning briefing.